All right, accounting three. Here's what we're doing the next 2 weeks. I'm going to take you through 15.3 this week. That's the statement of stockholders' equity and then the balance sheet. I wanted to get you through 16, but it is just, we just can't do it this way. I can't push you guys that fast through this. So once we get done with the statement of changes to stockholder equity and the balance sheet, we're done. So seniors, I'm going to get this stuff published out here today if possible. Today is the 2nd, and this gives you a shot at completing all the work for the year before you graduate. I'd like to have it by the 10th if possible, because I have to have grades in by the 10th. So anything you're going to submit to me, I need by Wednesday, the 10th. So it means I got to get this stuff out. So we're going to jump right in and do the statement of changes to stockholder equity. Now, I'm going to go through this fast. It's a short chapter. So this is not that difficult. Yet another financial statement. Now, what we've got to do here is we have to value the outstanding stock that we have issued. That's our capital stock. And we're going to be working with our retained earnings account, and we're going to be working with our capital stock account. So we got to prepare a new financial statement called the Statement of Stockholders' Equity. You might see it as a Statement of Changes to Owners' Equity, Statement of Changes to Stockholder Equity, SCOE. It all means the same thing. But this is one of the differences between a proprietorship and a corporation is that we have multiple owners, and rather than just doing the section on the balance sheet, we've got to prepare a separate statement at this point. So first step here is we got to value the number of shares we have out there. So we've got 100,000 shares issued already at the beginning of the year on January 1st of this year. And remember, this is the end of year statement. So at the beginning of this fiscal year, we had 100,000 out there. Now we have something called a par value. It's the value assigned to a share of stock and printed on the stock certificate. It can be an arbitrary number. A lot of times it's the value during the initial public offering. But let me go out here to one of these websites I got pulled up so I can show you what I'm looking at. Okay, par value, literally the nominal value of a bond, share of stock, or a coupon as indicated in writing on the document. It's what the company puts on the document. So it means a stated value or face value. So par value is face value. So that's what's printed on your stock certificate, assuming anybody even uses a paper one anymore, but the electronic stock certificates still have par value as well. Okay, let me reset this. Okay, going back to our chapter material. So first thing we have to do is under capital stock, we set it up who, what, when. Capital stock section, you see the colon there. That's what it means, section. Indent just a smidge. Okay, so the par value of our stock is $50. Maybe that's what the initial public offering was. It's whatever we decide. Beginning of the year, we had $100,000 worth. And then during the current year, we issued an additional 500 shares. So that's an additional $25,000 in stock. So the value of all the capital stock we have outstanding, meaning all the equity that we as a company have surrendered to owners, is $125,000. This is straightforward. All you have to do is get the number of stocks. So 2,000 shares times 50 equals 100,000 plus 500 shares at $50 par value, it's 25,000. Okay, now in the real world, this does change based on what the market value of the share is. This is the baby step way of doing it, because we're going to go out there and we're going to get the market value of the last closing of the last day of the fiscal year, and we're going to run our value based on that. Okay. But this is good enough for what we're doing here. So that's section one. This is pretty straightforward. Okay, and let's go down here to our next page. Okay, now we've got our second section here on our statement of stockholder equity. So first section is capital stock, and the second is retained earnings. And remember when we issued a dividend, we worked with these two accounts. We had to value them. All right, well, now we're updating the value of these. We've calculated our net income. We've declared our dividend. We've already run through that. Shareholders are happy. They got their dividend checks. Yay. We got money left over. How do we account for it? How do we report it to the SEC? Because we're a publicly traded corporation. Well, then we calculate our retained earnings. So we create a section for retained earnings here, and then the balance of our retained earnings at the beginning of the fiscal year, not next year, this year. So there's this number here. And if you remember, this is the value of our retained earnings at the beginning of the fiscal year. We had to carry that over from last year. So where do you find it? Okay, well, that's actually pretty straightforward. What we got to do here is, let me find it. Got to go back to our worksheet. Now, if everybody recalls, when we set up our worksheet, we just kind of plugged this number in because it was an entry in our general ledger account. And what we got to do is we just got to go find retained earnings. Where is my retained earnings? Oh my goodness, retained earnings. Up there we go, right here, retained earnings. So during the trial balance, we took the account balance at the beginning of the year for retained earnings and just plugged it in here. So this is the number we're going to be working with when we actually do this. But this is where you locate it. It's under capital stock, under dividends payable. So this is retained earnings we started with. Okay, so let's go back here. All right, no, that's not it. What am I looking for? Looking for the book. Okay, so that corresponds to this. We just plug this number in. Now, then what we do is we go back to our income statement and we pull the net income after federal income tax. I know I walked you guys through that. So we look at the net income after income tax. That's our $80,000 that we had left over from this. And we plug that in here. Okay, so how much dividend did the board of directors declare? We got $80,000. Let's distribute it to the shareholders, make them happy. So how much are we going to pay them out of that $80,000? We're going to pay them $20,000. So that's a quarter. That's a fair dividend. And we can go through and we can calculate our earnings per share and our price to earnings ratio. And this is going to be equivalent. So $20,000. Now remember, we got the math here. 80,000 minus 20,000 equals 60,000. So the net increase in our retained earnings this year, this $60,000 is what we're keeping. It's what we're not giving to our shareholders. That's here. Dividends is here. This is what we're keeping. So we started with 10 grand. We got another 60 to add to it. So we run the math. This plus this equals the new balance in retained earnings, $71,075.24 at the end of the year. So we have retained earnings of $71,000 that we add to the value of our outstanding stock, and that's our overall shareholder equity, our owner's equity, meaning that's our net worth as a corporation. That's what we got left. That's what the shareholders are entitled to. So they're entitled to a piece of this, and they can resell these. Again, if it's publicly traded, they can resell these, or if it's privately held, they can sell these to another private equity stakeholder. Think Shark Tank, okay? This is the valuation on Shark Tank that they're talking about. This is what they're talking about. You can tie it back to par value if you want, okay? How do you get that valuation? Well, you doggone better be able to justify it. Anyway, I digress. So the value of the capital stock on December 31st plus the value of the retained earnings after we've closed out, paid our income taxes, distributed our dividends is $196,000 for Hobby Shack. Okay? Straightforward as all get out. All right, I've got the PowerPoint here. It walks you through the problem with a couple of exercises and probing questions. I'll leave that up to you. You guys are smart enough to figure this out without me having to hold your hand through this piece of it. Okay, I'd like you to look at it, but I'm not going to belabor it. You guys want to get straight to the problem. Okay, show you the example. Let's do this thing. All right, so here is a book. So here is our worksheet. I provided a copy of the PDF there, as well as a copy of the papers that you'll need. And hint, hint, pretty much the balance sheet from 15.2, it's the key to the on your own problem because you got to have that to do this. Hint, hint, just saying. Okay, so 15.3 on your own. So we've got Now, here's the work together. I gave you the work. So we got Interstate Tires, I believe. And this is our statement of stockholders' equity for the period ending December 30th. So we're going to go up here and plug in our retained earnings. Okay. So we got 100,000 shares at $1 per share. Wow. Even Bunny can do that one in his head. 100,000. Okay, easy enough. Then we issued 10,000 additional shares. So $10,000. Okay, so our new balance is 110. Awesome. Sweet. Okay, moving right along. Now, you know what I did? I did this wrong. This is capital stock, not retained earnings. Capital stock. Sorry about that, guys. This is retained earnings. Okay. So a balance on January 1st, and I'm going to go back and again pull this number off of here. So 46,599.48. 46,599.48. 46,599.48. Just plug that in. So net income after federal income tax. Okay, go back and find it. So worksheets up top here on the materials provided. Here's the income statement. So net income after federal income tax. So this is our bottom line, 62,907.35. So 62,907.35. And I believe, what's our dividend? I believe we declared 8,800. Double check to make sure that's in the problem I give you guys, because you're going to need that. And if you don't have it, you can't complete the exercise. So let me show you where I'm getting that. All right. Corporation issue additional shares of capital stock. All right, we got to go back and pull that off our dividends. Let me show you where that is. So we got to go back up to where our retained earnings are. Dividends right there. So when you pull your dividends, you got to go down here under retained earnings and you pull your dividends right here, and then you plug that into the worksheet, okay? Just so you know where it is, right there, right above income summary. Okay, so 8,800. Now we run the math on this. We get this minus this, 62,907.35 minus 8,800 is 54,107.35. Okay. Then we run some more math. This plus this, again, this is an increase. Okay, we have more. We don't have a net loss. We had net income. So the value of our equity plus the value of income, which we closed to capital, increases our equity. And then we now have $100,706.83. So retained earnings, value of our capital stock is now our total shareholder equity is $210,706.83. Okay, guys, that's how you do it. So I'm going to post this up this week, and I'll see you for the video on the balance sheet. Bye.